Solana Stablecoins just reached a $15 billion all-time high. But there's a catch. The yield that those dollars generate doesn't stay in the Solana ecosystem. Critics say it's quietly being extracted by centralized issuers, but it gets even worse, because as it turns out, rival ecosystems are being funded with it. Today, we're following that yield to figure out if Solana traders are really subsidizing their own competitors and if there can be a fix. The claim that we're testing today is that Solana users create the yield and then a big chunk of it leaves the ecosystem. Now, we already know that these dollars help to bankroll Base, Coinbase's L2, Solana's direct competitor for users and for devs, because Circle reportedly paid $907 million to Coinbase in 2024, with a percentage of those funds coming from Solana-based DeFi activity. As Solana Floor journalist Finn rightly argues, by continuing to use centralized stablecoins that fund its competitors, the Solana ecosystem is arguably shooting itself in the foot. Now, we might just be on the cusp of dealing with this problem. But before we get to those proposed solutions, it really helps to understand the problem more intimately. So we did some digging at Solana Floor to really get to the bottom of what's going on. The stark reality is that USDC is by far the default Solana stablecoin used for swaps, perps, collaterals, payments, you name it. Just look at these stats. Out of the $15 billion of Solana stablecoins, Circle commands nearly a 70% market share. But this becomes even more impressive because when you zoom out and look at the entirety of crypto stablecoin landscape, it reveals a rather different reality. Tether's USDC accounts for $175 billion, compared to Circle's USDC with just $71 billion. That shows a 60% total market dominance by Tether. Hasib Qureshi succinctly explains this phenomenon.
So because of that, it turns out there are these cleavages in the US dollar stablecoin market that were maybe not obvious ex ante, but now they're very clear. And those cleavages, like USDC is dominant in DeFi. Like USDT really has very little penetration in DeFi. And when it comes to emerging markets, USDT is dominant in most of these markets. When it comes to exchange trading, USDT is dominant.
Now, that convenience of dominating the Solana stablecoin landscape obviously comes with economics. Reserves earn interest, issuers take some of the spread, partners get a rev share, and in Solana's case, the leak appears to be worth over $400 million per year. But that might just be changing for a few reasons.
I think Circle is a terrible business. I mean, just for reference, it pulled up their 10Q. Q2, their adjusted EBITDA was 126 mil. So you're like literally looking at what, like 1/40th of Tether compared to, what was it, like 4 or 5x the valuation. And I think for Circle, that is like kind of slowly what's happening, where it's like every single deal that you have to strike with every single exchange, every single large holder means like less and less revenue. And then everyone else sees that and they think, well, I should have some of that revenue too.
And that's exactly what's happening across the Solana ecosystem. Now that people have realized that 50% of USDC's off-platform revenue, aka yield from the Solana ecosystem, goes to Coinbase. And let's not pretend here that Circle is in any way a crypto-native company with DeFi-first principles.
The IPO Circle, which is the issuer of USDC, unlocked billions of dollars in pent-up demand for these issuers. After raising $1.1 billion during its debut on June 5th, the company's stock soared more than 700% just in June.
But this debate becomes even more important for the Solana ecosystem because people like Toli have long argued that stablecoins are crypto's current killer app, while people like Dragonfly's managing partner Hasib Qureshi have long argued that they have the best PMF among traditional businesses. So when we zoom out and we factor in that Solana has a far smaller share of stablecoins than, let's say, Ethereum, which leads by around $150 billion, by the way, it becomes clear that there is a lot of room for growth. So it seems only fair then that the yields generated within the ecosystem should stay largely within Solana land. Here are some of the proposed solutions. Helios co-founder Mert was among the first to speak out on this issue earlier in the month when he suggested that Solana could enshrine its own stablecoin and use the yield to burn SOL instead of letting some of that value created leak out of Solana. But this didn't come out of the blue, because the post followed a long and contentious bidding war among stablecoin issuers who were all competing to become the issuer of hyperliquid stablecoin USDH.
Where almost every major stablecoin player in the industry came out with some kind of proposal to become USDH.
And the problem, once again, was value leakage. In Hyperliquid's case, USDC deposits generated yield that was siphoned off by Circle rather than being reinvested back into the Hyperliquid ecosystem. Another textbook example of value leakage where the profits created by users somehow end up exiting the network instead of strengthening it.
Paxos basically promised that they were going to give 90% of the revenue that they made from USDH back to hyperliquid buybacks. And the other people started coming in and offering 95%, even 100% of all the revenue. Now, to be clear, part of the reason why this is such a big deal is that there's billions of dollars currently sitting in the bridge of the hyperliquid bridge, and all the collateral in hyperliquid is USDC, of which right now, ostensibly, hyperliquid makes nothing.
Now, clearly, there is a shift in sentiment among the most successful crypto-native platforms to try and retain some or even all of the value that's created by stablecoin volumes. And that makes total sense when you think back to crypto's original promises of things like disintermediation and decentralization. Going back to Mert's proposal, though, he followed up by suggesting a Solana native stablecoin is essentially inevitable, the most insane no-brainer in Solana history, he called it, because stablecoins are commodities. And currently on Solana, there is one that captures all the yield and literally funds Solana's biggest competitor with it. But not everyone loves Mert's idea either, because Lily disagrees, and she argues that this would entail an unnecessary set of trade-offs for the Solana ecosystem. DoubleZero co-founder Austin Federa also chimed in, arguing rather humorously that this is a bad idea both for the industry and for Helios's business. But there is, of course, more, because Lily further explained that an alternative would be to have a stablecoin and money market fund pairing that essentially wraps or white labels something that already exists and then uses that yield to buy and burn. For example, a branded stablecoin like SolUSD, which could take advantage of existing liquidity to generate yield for buying and burning Sol, which obviously would be extremely bullish for any Sol holders. And before we get to the biggest new arrival to the Solana ecosystem, an honorable mention for Solstice, which just launched a Solana native stablecoin of its own called USX.
Banks use your money to line the pockets of shareholders. Meanwhile, Solstice uses the same yield strategies to line your pockets. Introducing Yield Vault, Solana's best yield. A live delta-neutral strategy with positive returns month over month for 3 years.
Just like Circle and Tether stablecoins, USX is a 100% collateralized and composable stablecoin with nearly $200 million in TVL already. But the Solana ecosystem will likely look more favorably on it for obvious reasons. Here's Solstice co-founder Ben announcing a much-anticipated feature for Solana users during Accelerate conference.
We are introducing the ability to pay for goods and services with your generated yield on your USX, encompassing a revolutionary concept of buy now, pay never.
Now this is where things get really interesting, because another solution comes from KEEL founder KEEL, who recently suggested Solana needs a DeFi dollar while he was on stage at the Solana Stable Future event, and he added that USDS with on-chain reserves and the upcoming SUSDS can bring billions in liquidity and actually make stablecoin yields sustainable. Now for context, KEEL is a $2.5 billion capital engine from Sky, formerly known as MakerDAO, and it's being built to turn Solana stablecoin yield into growth for the ecosystem. It's powered by Sky's decentralized stablecoin SUSDS. And KEEL plans to actively use stablecoin reserves for things like liquidity, lending, TVL boosts, and then have it all flow straight back into Solana DeFi. KEEL explained that KEEL was founded on the belief that the next phase of on-chain finance growth needs more than new assets alone. It needs liquidity that can be accessed at speed and scale, and that KEEL is the first to provide these enablers on Solana. KEEL's plan could also help to attract more tokenized real-world assets to Solana. And that matters, because Solana's RWA sector has already jumped nearly 300% year-to-date. With KEEL, projects like Xstocks and Remora could finally get some of the liquidity they need, and of course keep more of that value inside Solana land. KEEL also suggests that its capital engine will allocate some portion of its reserves into tokenized yield-bearing assets and tokenized strategies. And this could once again be great news for Solana's growing RWA and tokenized equity issuers like Xstocks and Remora markets, which reported over $4 million in trading volume shortly after launching. Now going back to our original question of Solana yields being siphoned out of the ecosystem, while Sky's USDS doesn't entirely fit the bill as an exclusively Solana native stablecoin, it is certainly among the largest decentralized options active on Solana. Now anyone trading or transacting on Solana will agree that both Circle's USDC and Tether's USDT have proven themselves to be reliable alternatives. But the growing reliance on these two stablecoin titans is arguably counterproductive for the ecosystem as a whole. And clearly, people are rushing to fix that $450 million leak. Now the question is, how soon can that leak be plugged? And will there be a hyperliquid-esque bidding war for a new Solana native, enshrined, or even white-labeled stablecoin solution, as so far some of the proposals have suggested? Do let me know in the comments if you agree with the proposals, or if you feel particularly strong about Circle's extraction of ecosystem yield and funding of Base. Or maybe you think it's just business as usual. Of course, don't forget to subscribe to Solana Floor and do like the video to support our journalism. I'll see you next time for more of the very latest.